All right. We'll see if it says sending data, sending data. Is it actually broadcasting yet? We have this like game that we have to play. Periscope. Well, we're on Periscope. So thank you all very much for joining us. Just a little bit before we start, if you look directly above me, you'll see that we've already made revenue, which is pretty cool. So we've had our first sale on day 2, so that's not that bad. So we can all go home, I guess, right? That's all we needed. So I'm joined here with Calum Forsyth. He's the CEO of Seed Haus, the accelerator in Edinburgh. And we're just going to have a conversation about accelerators, about his view of different tactics and ways for people who are either leading early stage companies or thinking about starting an early stage company. How should you go about things? And just generally have a chin wag if we can.
All sounds good.
Yeah, so thanks very much for joining us.
Yeah, no, super excited to be a part of it.
So what exactly, and I think a lot of people have heard the term accelerator before, but can you just maybe articulate what is the difference between like accelerators, incubators, and other kinds of like similar things out there that people might have come across but don't necessarily know what they are?
Yeah, I think the language and terminology here has been eroded over time. So if we're to pare it back, I think historically incubators were physical spaces where folks would collaborate together, working independently on their own things. There's a peer network there. There's perhaps some form of coaching or support in some capacity, and the communities where the value is. Accelerators involved equity investment. So people were putting capital in, they tended to be cohort based. There was a program of support, a program of advisory support around that offering. And in fact, probably the definitive definitions would be the Harvard Business Review's overview of the space. And I think people would tend to point to those definitions, but happy to unpack some of those assumptions.
So when you say, so I mean, it sounds like an incubator, at least traditionally, it's mostly like shared office space for people that are working on similar types of things.
Absolutely.
And doesn't have a time basis.
Yeah, so I think that's very true. But I think what people often forget, and what the people who are good at these things realize, is it's about protecting the community. So incubators are super easy to set up in concept. They're very difficult to execute against. Because you are protecting, as you say, building out that great community, and getting like-minded people collaborating together. Okay,
and accelerators, on the other hand, I guess it's the key is in its name. It's a program. It's usually connected to a program.
So perhaps one way, there's a couple of ways to say what you actually accelerate. You could be a bit hand-wavy about it all. I think I would be pointing at the valuation of the company.
Sure.
So over the course of 3 months, 6 months, can you triple that valuation? Can you 4x it, 5x it?
Okay.
If it's a true accelerator, that's what you should be doing. And I think over time, people have started to think of any program of support as being an accelerator. Whereas I would say, if I were a founder, I would be looking at valuations of folks going in and coming out of accelerators. I think that's a helpful heuristic to look at.
So does every founder need to go through an accelerator?
Absolutely not.
And why?
Absolutely not.
So why do some find it helpful? Why do some really need it? And why do others not?
Absolutely. So I would almost take a step back there and really firm up around what being a startup means.
Sure.
So as we've chatted about before, it doesn't necessarily mean just starting a business. It's a business that is in search of a reproducible and scalable business model. Now, that's a very different thing from starting a bakery or a service-driven business. Yeah. So, yes, it needs to be scalable, in my opinion, to engage with an accelerator unit. Think about what it is that you want to gain from it, and I think this is where people go in and they're not sure what they want. There are certain accelerators that you perhaps engage with because they're a route to market. They're perhaps a procurement channel for a corporate entity.
Sure.
And it makes sense to engage with them if you were looking for an into their procurement channels. Perhaps there's a skill set or an area that you feel you're weak on. There are accelerators that perhaps cater to that. But accelerators that don't offer investment, in my opinion, unless there's a very obvious tangible benefit like a procurement mechanism, it's tough to actually consider them as true accelerators, because if you think of the underlying business model, accelerators that are putting investment in, they are pretty well aligned with the founders in terms of, we want this business to be a big scalable business. Sure. Now, in accelerators that don't put that capital in, they're involved in throughput of businesses. So there's two things to be mindful of. But to circle back to who it's a good fit for, I would say it's folks that are looking to build high growth, scalable businesses, and that's your starting point. Whether or not you should do it is a separate bit that we can chat around.
Sure. Okay. So there are a couple of points that you kind of made there. There are these things that people see out there that are free accelerators, which makes it more sound like, I don't know, if they were to be called a boot camp, or if they were to be called a community or a program, maybe that would be a little bit more appropriate. But then there are other accelerators that are free in the sense that they don't invest any money in you. They're reverse free, but yet they still want to take equity. And these have become quite common, especially in recent years. And it's about valuing their network or the equivalent of all the advice they give and how much that's valued. And there seems to be a split in terms of what people think about those. So what do you think about those? I'm not saying like the free programs that also don't take anything. I'm talking about the free programs that actually do take stuff.
I'm super wary of those ones, because to my mind, you're almost setting yourself up as either an accelerator or a micro VC. You're operating with that mindset, and that's the game you're looking to be playing, but you're not actually putting the capital in. So I think accelerators and micro VCs, people in that space, putting that capital in, you're buying your seat at the table and doing that. Where I think it's perhaps a bit more palatable are where you have some of the top tier folks like Techstars, for example. I think they had a mechanism where folks could surrender 2% equity or something like that to do the program. And Techstars, a brand name, they've got a phenomenal record. You could perhaps say that maybe be a sensible move if folks are looking to raise an institutional seed round. Newer players, a little bit risky. I would just say do proper diligence on the founding team. That might be one way to assess if
bring up an interesting point about diligence. So when someone is I mean, anybody who, out there who is a founder of a business that maybe isn't considered or is potentially one that is high growth, you get emails all the time coming from accelerator this, accelerator that, come and do our program and get in front of investors. What kinds of diligence would you expect a founder performing on you and Seed Haus? And what advice do you have for people about like what kind of questions they should be asking, especially if the accelerator that they're considering isn't necessarily a big, big well-known one?
No, it's a great question. It's a super positive, encouraging sign when founders do their diligence on us as Accelerator. It's such a great thing. As a starter for 10, I would say actually reach out to folks that have either been through the Accelerator, or if it is the maiden cohort, I would speak to people that the founding team have collaborated with or worked with in the past, just to get a bit of a character vibe, build up a little bit of a picture around what motivates them, what incentivizes them. So that's a quick win in terms of assessing that founding team. Digging in the capability, it may well be, it depends as to how the accelerator are selling themselves. So if they're promising, and a lot of folks do promise the world of, we'll help you raise your Series A and all this good stuff, I would see, who exactly they have supported on that journey, and even jump a step and speak to the Series A investors. At that very, very early stage, I think people are reluctant to, so from a founder perspective, some people might be a little bit afraid to reach out to a Series A investor and think, oh, I'm not at that stage yet. But I don't think there's anything wrong with just shooting off a couple of emails and saying, hey, we're speaking to Accelerator X, they name dropped you folks, should we do it, or are they a good fit? So I think there's a couple of quick wins that you can do there just to get a feel for if it's a good fit or not.
And and again, stepping back to the different kind of types of accelerators that you were talking about, a couple, correct me if I'm missing any, but it seems like there are kind of more generalist accelerators that don't really necessarily care where you're coming from in terms of a business. But then there are also, and also they're kind of stage agnostic as well.
Yeah.
There are specific accelerators that cater to a specific stage, but are more generalist. And like they are pre-seed accelerator, or they're a Series A accelerator, or something like that. And then there are industry specific ones. So you're going to go for a SaaS accelerator, or just tech, or healthcare, something like that. And some of those, I think oftentimes are the ones that are attached to companies. And why is it in a company's interest to run an accelerator that might not necessarily bring with it investment? Why would I don't know, we can talk through some examples, but like why would a company, what motivates them to run an effective accelerator, and why should a company kind of a startup trust that it's a high quality program just because Porsche runs it or something?
Does that make sense? Yeah, so there's a couple of motivators there. If we're being very cynical, you could say the press and the PR. And if we really dig in on the inner workings of some corporates, and if you're to approach it with a very skeptical hat, imagine someone's going for a promotion inside one of these larger organizations. It's super easy to suggest a corporate accelerator or an innovation lab as a sort of pseudo PR piece. So you can look at things through that lens. And yeah, I don't think that's a good fit for anyone, in my opinion. Perhaps the optimum mechanism and the reason to engage would be a case of the corporate is looking to engage with technology in a certain vertical. In my experience, the gulf is just too great for folks to bridge.
You mean you either have really, really great ones that are top class, and there's a very specific reason?
No, more so from, I think there's a lack of awareness amongst a lot of corporate partners around the level of maturity of some startups. And that's not a reflection on the ability of the founders, it's just the stage of growth of the company. And sometimes that can be an uneasy fit.
So like if I'm a large company and I want to create an accelerator, I might have good intentions and definitely want to help, but because I'm just by its very nature, because I'm a large company, it's going to be hard to help them? Is that what you
Yeah, absolutely. So maybe we could expand that a little bit. So let's take fintech as a space. People are super excited about that vertical. If you are building a fintech company, chances are you're going to have to comply with some pretty meaty regulation. There's all sorts of processes, and historically it's not a super fast moving industry. Now, if you're running a corporate accelerator in that space, you need to be mindful of the fact that the founders, the startups on the ground, might only have 6 or 9 months worth of runway. Now, in a corporate sense, they're used to working on year time frames. And so some industries, it can be difficult to really align working on those time frames with how the industry tends to behave. So that's just something to be mindful of.
So if you have a startup and you are like a B2B startup and you're specifically targeting a certain type of like enterprise client. Again, let's just make up these. I don't even know if they have these, but you want to target someone like PwC. I don't think PwC has an accelerator or not one that I know of, but let's just then that makes it easy. You want to target PwC because you're building something that PwC might be interested in as a corporate client. Let's say they had an accelerator. But because they have an accelerator, it's probably not one that is including. It might not be including capital, but also probably is not taking any equity. Is it worth? If you definitely know that those people are your customers, is it worth engaging in a corporate accelerator simply for that kind of access?
I would say the trade-off is on the time commitment. So what is the expectation? So if the accelerator, in inverted commas, is 4 afternoons over the course of 2 months, it's maybe worth it, and you join an online community, meet some of the team, potentially. If it's mandated attendance every day for 8 weeks, probably not a great idea, probably not a great use of time. It's also very tempting for startups to covet a marquee name client, a big name that we've all heard of. Again, in my experience, it's difficult to land, it's difficult to manage those relationships, and I would actively discourage most startups from going after those big clients in the early days as well. So
instead, just look at the kind of more typical approaches.
Unless you actually have the bandwidth to devote to, you know, if you're going to understand the procurement process of a certain industry a little better, or you're going to expand your network considerably, and it's things that you couldn't do on your own, then yeah, maybe think about it. But I think some people forget you can actually achieve a lot just by reaching out to folks on LinkedIn, etc. So yeah, do I need to do this accelerator? What I would say people often forget is founders tend to think these things will credentialize them in some way. Yeah. And if there's no exchange of sort of capital for equity, you could perhaps argue it isn't an appropriate credentialization mechanism, and you shouldn't be pointing to it for that purpose.
Okay. There's this kind of culture, if you want to call it culture, around what accelerators are like, and you know, the general kind of startup culture of you get yelled at, you get put through your paces, you have to do a week of thinking about your branding, and a week of doing this, a week of doing that, and then you have these pitches that you have to do, very strictly kept to time. You have these demo days, and at the end of the demo days, a whole bunch of investors are carted in. You get linked up with a whole bunch of people, and by the end you'll have like term sheets signed. I imagine that is probably quite accurate in some ways, but I imagine you probably don't think that's entirely healthy. Yeah. And why is that not necessarily healthy?
I think there's just a management of expectations, and it's something that we all go through when you are on the founder side of the table. I think people expect perhaps too much from investors, or they think that relationship's going to evolve slightly differently than it actually plays out in practice. I think a really regimented framework, prescriptive, we're doing sales this week, marketing this week, I don't think it's useful. I prefer to see folks that are self-aware, they know what they need help with, and they can tap into the community and the network of the accelerator to address those things. In terms of, so if you're to skip to the end and we're talking about demo days if you're to sit on the other side of the table, so now you're putting your investor hat on and you're seeing all these opportunities, you're seeing a lot of stuff that is, on market, so to speak. So every other investor is seeing these folks. If after a few weeks they haven't raised, that's perhaps a sort of dangerous signaling thing. Whereas I think if you're to do the sort of slow burn approach, there's merits to that. If you're coming out of something like YC or Techstars and it's all singing, all dancing, that makes sense. But in other setups, it can be quite dangerous to get that level of exposure at a stage where you're perhaps not ready for it.
And but there's this emphasis though on pitching, and being able to have a slick pitch, being able to do it within 4 minutes or within 3 minutes or in 1 minute or whatever. And there's a lot of benefit to going through a process like that, just because of being able to crystallize it in your own head. But I think it seems like we kind of pray at the altar of pitching sometimes. And someone who's never done this before maybe looks and sees that and thinks like, okay, well that's the marker of success, right?
Absolutely, and that really came out of the US in my opinion. And I find it strange because it's bled into, so the US, as you're well aware, is predominantly extroverted culture and society, but it's actually bled into other geographies, which if you're to look at the UK, for example, I think there's a closer 50-50 split in extrovert and introversion skill sets, which I find strange. The reason, my theory for the sort of demo day stuff being so prevalent, is a very obvious focal point. So there's something to point at, there's something to get the press excited about, it's engaging investors.
It makes sense if you think, like if you think about it, it makes sense.
And even from my perspective of running a space, something of an artificial or an enforced deadline, it means that people are working towards something. And again, digging into some of the engineering parts that I would do, it forces a sense of camaraderie in that it's a scary thing to perhaps pitch your company for the first time, etc. So there's perhaps merit in the fact that as a cohort, folks are going through that together, and that does help strengthen some of those ties. So there perhaps is merit in some sense to do it. I would say where it falls down is a lot of people come to this space think that's what building a startup is. Whereas, I've raised money, I've helped invest in a bunch of folks, I've listened to a handful of pitches in terms of, if someone starts pitching me, I tell them to stop and we just chat. I don't think I've properly pitched to anyone ever. That's not really how it works. But it's an obvious focal point. So if I were PwC and I'm running a corporate accelerator, I would probably do a demo day because I can invite all my bosses and all my network, and there's an obvious focal point to it. That's not what building a company is. So I actually really like working with folks who resist the sort of demo day, the theatre, the extroversion, because I think that level of exposure, it goes against the sort of ethos of startups, which is this embracing learning and embracing failure, being vulnerable, putting yourself in front of your peer group and a body of investors. You're perhaps getting your identity and your ego tied up too much in things at a formative stage, which I actually think isn't super helpful.
So we've talked all about the kind of founder side of the coin in terms of accelerators. There's another job, though, that accelerators kind of have, and that's kind of like a gatekeeper to these companies for investors.
Absolutely.
So on the flip side, if I'm an investor, an early stage investor, and I kind of want to have access to some of these companies, I think a lot of people assume that investors just get access to whoever they want to. But if you are a decent company or a decently successful company, you won't necessarily have time to speak to any old investor that contacts you. And I think that maybe sometimes comes as a bit of a shock initially to early stage investors. What advice would you give an early stage investor, someone who maybe wants to get into early stage investing? They see a Seed Haus company and they've been trying to get in touch with them and they don't seem to be hearing back. How would you advise them to go about trying to start that relationship?
So from an early stage piece, I would always say put super small amounts of money in building out the network. So a lot of people come to the space and think, right, I've got to start writing these big checks, or how does this process work? There's mechanisms and accelerators in place that you can go and engage with. I would actually say you're better to start with a crowdfunding platform, an equity-based crowdfunding platform, put up £100 or $100 in a whole bunch of companies, review their investor updates every month, learn about the space for a year or two, and then go and engage with those types of folks, because it goes back to my point around stuff being on market and off market. Chances are, if you're coming to the space thinking, hey, I want to do some investing in these tech businesses, by the time you're seeing it, everyone else has turned it down. So that's just something to be mindful of for folks coming to that stage. Whereas some accelerators can help say, well, they're at least credentialized in the fact that these folks have put money into them. They're probably worth taking a proper look at, and they've been de-risked a little bit.
Cool. So thinking about Seed Haus specifically, you are a pre-seed investor. And so what's the difference between seed, pre-seed, Series A?
It depends on the geography you're in. Super
and how you're feeling that day.
Super glad you asked me this question. So it depends also if you're talking in an institutional sense. There's folks that will now say seed is a gradient in terms of what used to be seed and Series A. They've kind of moved a little bit. Pre-seed, I would just use that as anything before an institutional raise. So you can do a couple of pre-seed rounds.
And just by institutional raise, you mean like a venture fund?
A venture firm, or some of the larger sort of hybrid angel syndicate funds. I would tend to call that sort of seed piece. So we're the pre-seed, which is super early. It's all about de-risking folks. Some of the terminology people might hear is friends and family rounds, which I don't like, in that it implies that you need
hobby.
Or you come from, so one, it means you've got money from folks who don't necessarily know what they're doing, and secondly, you're only really empowering folks that come from money or have those networks already. Whereas something like Seed Haus at the pre-seed space, it helps to empower folks from a variety of backgrounds. So I'm pretty passionate about that, and I think that the pre-seed space, most folks that you hear that terminology pre-seed, it is to really address that sort of gap in the market. And
so when a founder is considering or a founding team is considering an accelerator, if it is one that is offering investment, oftentimes that is in exchange for equity or a convertible note towards equity in the future. And that's also usually the first time that you are giving up
selling.
An amount. Sorry?
Selling.
Sorry. But yeah, but the way that you're kind of feeling is that you're giving this away.
Yeah, absolutely.
Right? Even though you're right, you're
Yeah.
selling it, right? And with that, as soon as that happens,
Yeah.
you suddenly have a valuation.
Yeah.
You also are usually dealing with the same terms that everybody else is dealing with.
Absolutely.
So I might be running a fancy, I don't know, SaaS business doing 100,000 a year in ARR, and someone else just has an idea, and we both have to give up 5%, 7% of our company. How should founders think about, especially if they haven't done this before?
How
should they think about that mentality of like, oh, I'm giving this away?
No, it's a great question. In terms of framing it, there are real arguments, and I would probably tend to agree with them, that thinking of the evaluation coming out of an accelerator is relatively meaningless in terms of what that number is at time of deal. I know we talked roughly about valuation earlier, but as a rough heuristic, you can't necessarily say these companies that are all in different industries have the same valuation. It's a difficult one to compartmentalize, and it's funny because that's the point in the sort of negotiation process where suddenly you almost see the whites of the founder's eyes, and it's a case of, this is getting very real all of a sudden.
Term sheets.
So it's a good education piece on that part. And I would say it's some people, as a way to get around the valuation piece, you do a convertible loan note, which sidesteps the sort of pricing issue. There's also the fact that if you are, as you were talking about, if you're, let's say you're doing 100k ARR, what have you, or someone's got an idea in the back of an envelope, a lot of people don't necessarily need the money with an accelerator. It's the value that the network brings, it's the support, etc.
Money is almost a validation piece on the flip side.
Absolutely. Right. So it's a tough one to reconcile. There's no easy answer for it, and I wouldn't say it should be an easy decision at all. It absolutely shouldn't. And I think it's a good sign that founders actually, I'm not here to convince anyone otherwise, you should be thinking about those things and thinking how it relates to you and your business.
Okay. I'm conscious that this is going to verge on to getting a little geeky, but I would really like to. You mentioned convertible notes, a convertible loan note. That some people watching might not actually understand what that is. So what is a convertible note versus an equity investment?
So if an equity investment, we would have a chat and say, well, we've priced the valuation, we think the valuation of your business is X amount, let's say it's $1 million. A convertible loan note, I would say, oh, well, I want to be a part of this journey, I want to buy some equity, I want to put some money in, but let's postpone the valuation chat to another day. We think the valuation is going to be a minimum here and the maximum here, so you're setting a boundary of where it will convert, but we can sidestep that valuation piece altogether, and it just means that we don't have to go through the process of doing a priced round, which can be quite lengthy in terms of some of the things you need to decide upon, documentation, legal costs, professional service advice, whereas at an early stage it can be much easier to take the convertible loan note and just crack on. There are a few things to bear in mind though. What are the ranges on the conversion piece? So some founders can get burned on that. So that's good to be aware of. And some investors would like more protection than some loan notes will provide. I would argue that in the UK, there are a lot of pretty good tax breaks and tax incentives associated with early stage investments. So
SEIS.
Absolutely. So it is relatively well de-risked in the UK. But some US investors would perhaps feel exposed with some of the protections afforded to them through a loan note.
So why would then an investor, and why is it so popular in the States maybe, but why would an investor participate in or want to participate in a loan note? For example, because what you're saying, if I understand it right, is I'm going to invest money in you, but I'm not going to actually have any equity. Until you may go through a round in the future, and only then will my investment convert into anything. So until that time, I could own 1%. I could own 3%. I don't know. You
Yeah.
know? So like, why would I be interested in actually doing that?
From an investor
From
perspective,
an investor
yeah,
perspective,
absolutely. So it would be speed of deployment is much easier. Just cut a check
Sure.
and just wire that over.
And you're saying that like you can do your deal with me, and then you can do your deal with someone else. You don't have to wait for us both to come
Absolutely,
on board.
yeah. I see where you're
Keep
getting
it
at with
open.
it. Yeah, so you keep the round open. So again, you wouldn't necessarily need to say, right, the round is closing at the end of April, and we've all got to do the fundraising dance, and yeah, that can be aligning investors can be a bit like herding cats, as we're both well aware.
Exactly.
Whereas doing a loan note, you can do things more on other people's time and on their terms, etc. So you could keep the round open for 4 to 6 months, and it's a case of we're taking on a little bit just now, a little bit more to keep us going. Right, we're doing the proper priced round now, so it can just be a little easier to keep the show on the road, so to speak, and raise through loan notes for sure.
Does it also give like investors any kind of added benefit or I don't know, increases their options going through a loan note, especially in the early stages? Maybe not even a loan note, just a note.
Yeah, so if there's a discount on it or what have you, you can actually get some pretty good prices. I would say there's maybe even some investors that wouldn't necessarily want their, again, different geographies, perhaps don't want their name on the cap table at this stage. There's all sorts of little intricacies that you start to sort of dig in on. I think they're a useful instrument. I think founders should just do their sort of diligence on what they are, and there's loads of great resources online around using them as instruments. And I would say for most early stage businesses, so if your valuation's under 1.5, 2 million, a loan note's probably the optimal mechanism, because if we are to really get into, if you and I are to invest in an opportunity and someone walks in here with an idea on an envelope, how do we appropriately value that? So, it just sidesteps that whole thing.
And going back to accelerators, some accelerators like to use loan notes.
Absolutely.
Some accelerators don't.
Yeah.
They use equity, and some use both. Yeah.
So you could argue that a priced equity round is a good education piece for founders. It's good to learn these things. It doesn't necessarily get any easier. But at least you know what you don't know going through it that first time. And you perhaps might take the investment a little bit more seriously if you're going through a priced round versus a loan note. Sometimes I see founders being a little bit flippant. Perhaps the money came not easily, but through different mechanisms. So there's a whole host of reasons for doing that. A lot of folks will do a sort of small priced round, they put maybe 10k in and then a loan note on top of it, and it just avoids the sort of challenges of
you have nobody else on your table.
Yeah, absolutely.
Yeah. Interesting. Okay, so actually the founders will do a combination.
Yeah, so you'll see them do a combination.
Okay. So when thinking about potential companies who are applying for Seed Haus, and maybe you could extrapolate this for other people, a lot of people worry about validation. This is oftentimes the first time they're actually showing their idea off to someone else, and they should be worried about can they convince you that something is viable? But you're also seeing things at the earliest stage. So what good looks like to you might be very different to what good looks like to Andreessen Horowitz.
Absolutely.
So especially if anybody's watching who may be thinking about applying to an accelerator, what are the kinds of things that you look for? And what are the kinds of things that you'd expect to have happened? And then on the flip side, what are the kinds of things you don't really care about that maybe they think you might care about?
So I think picking up on the sort of demo day piece, a lot of folks will come to this with the expectation that it needs to be this super polished product to bring to the table. They've credentialized themselves in some way, whereas we would rather just see what you folks are doing, a really simple concierge-like service, maybe a simple landing page. We've validated that this thing is a problem. There is a market here. I don't necessarily care about how much people have spent building out products. I actually get concerned, and it's actually probably a negative signal if I see someone that's spent 30, 40,000 building out a product that they haven't even validated if people need it. So that's quite a dangerous assumption that people bring to the table. In terms of some of the attributes, I like seeing people that are in love with the problem as opposed to in love with their own solution, which is always dangerous. you're the easiest person, you personally are the easiest person to fill.
Yeah.
So it's super easy to convince yourself that your solution's great, and then get your ego and identity, etc., tied up in that. So yeah, there's a few other sort of positive signals. I would say it's one thing to be mindful of is I think people think they need to, again, going back to this pitching thing, when people will come in and they've psyched themselves up like, I'm gonna, this is my one shot. It's like, calm down. You got plenty of shots at this. I would actually like to get to know you, and we spend some time together, and I can see how you think and how you tackle problems and how things evolve over time. That's super useful. Rather than, hitting a home run. We would rather do a bunch of singles. It's just cool to spend time with folks and see how they think and how that evolves. So yeah, there's a couple of ways what good looks like. First meeting, I don't expect people to know all the terminology or all these things. I think it's nice to chat around the problem. It's nice to have folks, not necessarily aggressively, but sometimes if I were to challenge some assumptions, it's nice to actually see them push back and educate me as to why I'm not wrong, why I'm wrong. Not that they think I'm wrong, but we've actually got data that says you're wrong and here's why. That's really encouraging when people do stuff like that. I know it's, again, perhaps bringing some biases to the table, but are these people likable? If the shoe were on the other foot, would I want, and again, this is how I see it, if we're investing in folks, I am going to be working for, and I say I am going to be working for that team until such time in the future. So do I like them? Do I want to hang out with these people? And yeah, it's amazing the number of folks that will try and talk down to you at an early stage because they think they're impressing you with their technical knowledge, and it's not super endearing.
That's super endearing. I like that. And the idea of someone being coachable, and I guess there's a line between someone being coachable and someone being a pushover.
Yeah.
Is that fair?
Absolutely. So maybe one of the ways to think about someone being coachable would be they perhaps look for some form of data that would back up what we're chatting around, or oh, that sounds interesting, Calum, but can you point me to examples of that elsewhere, rather than just accepting what I'm saying verbatim. Perhaps that would be a pushover. If it's a case of, oh, advisor X has said this, I will prescriptively follow that. That's very dangerous. I think you should always be gently pushing back, but at the same time, being coachable is difficult to define. You know when you see it, which isn't helpful. But that tends to be the case. Yeah.
Also, just the kind of general, don't be a dick.
Yeah, for sure. Which is huge. That's almost like 101. If you can jump that hurdle, then you're laughing.
Exactly, then you're laughing. Exactly. Well, thank you so much for taking the time and for spending spending so much time talking with us. I think we could probably talk about convertible notes and all these different instruments all day. And I think that would be a very interesting kind of discussion. But yeah, really appreciate it. Thanks.
Awesome. Thank you so much. Cheers.
Okay. Well, thank you all for listening. We're gonna switch back, and Lizzie will be up pretty soon to showcase one of our products.
Tremendous.
All right. Thank you very much.